Since Fed Chair Jerome Powell spoke in Jackson Hole, the market has gone down, excluding today, 7 days in a row. Remember, the chance of the market being up or down any given day is 50%, 50-50. 7 days in a row of a down market. And several of those days started up significantly, 1.5%, and still finished down. The last 7 days have been brutal. And I do believe it's been an oversold situation. I have no data to support that. But just in general, when you see 7 down days in a row, that just feels like we're going to have a breather at some point. Now, today, the market's up a lot. Makes sense. But 7 days in a row of down market, at some point, we're going to have a pop. But do I believe that we're in a rebounding situation for the market? I do not. I've been very clear about this. I will repeat this till I'm blue in the face, because what's most important is repetition. When we're doing and learning a lot of things, your goal is to repeat over and over and over again. That is extremely crucial. I do this for myself every day. I look at the stats every single day to remind myself not to get caught up. So if you're new to this channel, I'm Paul. I'm a value investor. My goal is to use my 8-pillar process on stocks in order to find investments from a quantitative perspective, using the numbers to find interesting opportunities. Once I've found those, I do a little more digging to determine if my assumptions are correct and if I should go enter the stock or not. My goal is to buy when price and value are disconnected, when price is a lot lower than value. And that happens because people get emotional about investments and they exaggerate good news and bad news. So when stocks are exaggerated up because of good news, I avoid them. When stocks are beaten down because of bad news, overly beaten, I enter them. That is the goal here. So if you've watched my videos before, oh, and by the way, please follow me on Instagram at Paull Gabriel. It's popping up right here. I basically take pictures of my dogs and my fiance. So I've shown this graph so many times, it hurts. But this is important. It's important you get this ingrained in your head, not just for this bull market, but you're probably going to experience many, many bull markets in the future, and it's important to understand. This was our run-up in years past. We've had a fall this year, and I feel like we've had the rebound, and I think we're right around here somewhere. I think we're not even close to the down part of the market. Why? Well, there are 3 major metrics that I look at. Stock market to GDP ratio, the 10-year cyclically adjusted PE ratio, and the price to sales ratio. These are 3 long-term reliable metrics that are very good at determining what the future holds in terms of stocks, in terms of the returns, okay? So let me get into that right now. The first metric, after a 7-day-in-a-row fall, the stock market to GDP ratio is currently 155%. It was around 160 to 162 right before this fall. Now it's 155. This takes the entire stock market value and divides it by GDP. It should be around 80% for decent opportunities in stocks. So almost has to fall in half. That's one metric. The second one, the 10-year cyclically adjusted PE ratio takes the earnings on the stock market over the last 10 years, brings it to today using CPI, inflation, and divides it into stock market price. It's 30. The historical average is 15 to 16. So another metric that's very reliable, saying the stocks have to fall in half. Final metric, the price to sales ratio. It's currently 2.45. Historically, the average is 1, which is a bigger than 50% drop. However, for this one, I do think the price to sales ratio should be higher, because using all of history, when manufacturing was a big component of our business with a much lower price to sales ratio. Now we have more service-oriented businesses that have a much higher price to sales ratio because their profit margin is so much greater. But either way, all of these say that the market basically needs to fall in half. And the interesting part is there's a lot of great value investors that are now coming out saying they think S&P should be sub 2,000, which is about falling in half. I've been saying this for a while. Actually, I've been saying lower for a while, but as time has gone on and the economy has gotten better, it pushes up my base value. So 5 years ago, when I thought stocks were overpriced at 2,000, but I thought the stock market was worth around 1,200. But over time, things have gotten better. So now I think stocks are worth about 1,800 to 2,000. But remember, guys, this is the interesting part that I want everybody to remember. And this is what's very crucial. This is where stock values go in the long run, but this is how they get there, right? They're either over or under. And that's why your job is to buy along the way. That way you can get the average over time. We're never at the stock market's value. We're either overvalued or undervalued. And your job is the dollar cost average. But if you take a portion of your portfolio, want to buy individual stocks, be patient. When stocks go under the value, because there'll be a day in the next few years when I'm telling everybody on these videos, guys, stocks are massively undervalued. People will be saying, Paul, you've been saying that for a while. I know. That's the bad part about being a value investor. You're always perceived to be wrong. When stocks are high flying, you're crazy for not thinking they're going up forever. When stocks are dead and down, you're crazy for believing in these companies you can't make money in stocks. But that's what it takes to make a lot of money in the stock market. You have to think differently. And not just thinking differently to be difficult. It's thinking different from the emotional aspects of investing. And the last 7 days have been a negative emotional aspect. And there can be short blips of overbought and oversold conditions within markets. And I think the last 7 days were oversold. People have to weed out, okay, let's get it out there. Let's go buy some more. Who knows what happens from here? We can go up 10%. Remember, just because the stock market is going down over long periods of time in a bear market. For example, when stocks go down, they don't go down like this. They go down like this. Just like when they go up that way as well. Remember that. In the past bubbles, when the bubble pops, there are several rebounds of 10 to 20% along the way as it goes down. And people think, oh, thank God it's over. But it's not over. We still need to weed out the crap. And at some point, the stock market will be selling at much lower values, much lower prices than its value. But my guess is in the next 10 years, my thought of the stock market being worth 1,800 to 2,000 will go up. And maybe it's worth 3,000, but the stock market's still selling at 2,500, which is still below its value. And that's the point. And that's why I refer to values, these 3 long-term values when I look at value investing. And you're going to see me bring these up till I'm blue in the face for the rest of time. Does that mean I avoid stocks if it's overvalued? No, of course not. But when we're in these extreme levels that have only been seen 1 or 2 times in history, and those times when it happens, it ends up being ugly for stocks for the next 5 to 10 years, I exhibit some caution. But I'm different than everybody. I've got 8 or 9 businesses upstairs, all generating me cash flow. I make dividends. I sell options. I have so many revenue streams. It's okay for me to be patient. But for the average viewer out there, that's why you're watching. I'm here to help you and show you need a dollar cost average every single month because we don't know where stock values are going to go. And if you'd listened to me 5 years ago and sold all your stocks, if you'd sit there and said, well, Paul's doing that for himself, you would have lost out on a lot of gains. And that's why you can't do that. But what I do encourage you to do is, if you want to be more aggressive, when times are down and stock values are lower than their value is supposed to be, add some more money to the market every month, every week. Whatever dollar cost average you're doing, maybe you increase it. And you'll probably do very, very well over time. Because just matching the market will help you beat 92% of actively managed mutual funds by all those Harvard MBAs out there. You'll be able to beat them over a 10-year period like crazy, and you won't have to think about it day in, day out. But if you love the process of learning about how to buy a stock, you need to watch this next video about our 8-pillar process so you can take a portion of your investments and go look at individual stocks. Please subscribe to our channel. Thank you very much for your time.